just quickly, my background. I'm a entrepreneur that has turned venture capitalist, and I got into venture capital to solve an entrepreneurial problem, which is that across my career, I've been very happy to have companies that I've founded, exit, including one to Oracle. But I've also had companies get stuck in what I call the stay private forever machinery. And I'm going to talk in the slides ahead. Hopefully, they're dramatic enough for Marty about sort of the shift in the markets that have occurred over the last couple of decades here. But most importantly, I also think there's a shift in global capital flows, and I'm going to talk a little bit about that as well. And in particular for family offices, for venture capital as an asset, there's a real debate as to, do you stay private forever? Is it good to stay private forever? Should we go public? Is an M&A a better exit? And I think these are all interesting and topical conversations that I want to hit on. By background, Global Public Offering Fund is growth stage venture. We are focused on, think series, B, C, and D, firms that are in the 100 to 500 million in market cap. And I like to say we have three really strong biases. We look for globally scaling companies that are founder-led, that want to move into the public markets. And those three biases are very intentional. And we believe they help us create a selection bias for our investor base that is unique. The first thing I want to talk about on, and I've only got 3 slides here, so I'm going to, not move deep into presentation, but there has been a dramatic and permanent structural shift in the United States that I think few people realize the magnitude of. The IPO markets shifted in the late 90s to early 2000s. And we moved from what was a period of 400 to 600 IPOs a year to an environment for the last 2 decades that has been between 100 and 125 IPOs per annum. And that is a dramatic shift. There used to be a Russell 5000. We don't have 5,000 listed individual stocks to create that index anymore, right? There used to be 8,000 listed companies. There's half of that today. We have more passive investment vehicles that investors can go into than we have individual listed stocks. There's no longer a stockbroker that calls you. There's incredible regulation around taking a company public. And we could talk, for days about why did this shift occur? Things like decimalization, things like, the advent of online trading, Sarbanes-Oxley, Dodd-Frank, so on and so forth. But at the end of the day, it's a permanent structural shift, and the market hasn't come back. We now live in a mega cap market. And something I want to point out is what drove that 80s and 90s was the creation of great companies like NVIDIA, Intel, Amazon, Microsoft. And that engine was the lifeblood of our tech environment. Today, we live in a world that's much, much, much more M&A driven, or much, much more stay private forever. There is a correlating chart that shows the growth of private equity. And that's, in part, and I love this, CB Insights chart from a couple of years ago that shows that implosion of unicorns. That today we should probably have a chart that shows the implosion of decacorns, right? But we've moved into a world where we, on a venture capital world, are very hit driven, right? Everyone wants the next Facebook or the next Uber. Nobody asks about, what about the 4,000 smaller companies that are very economically vital to our tech industry, to our life sciences industry, to our job innovation. And someone mentioned earlier the SVB bailout, and one of the underlying issues there was that there were 40,000 companies that sat behind that need for a bailout. That's a lot of payrolls to stop in 36 hours. And it was a real conundrum for what do we do, right? And it's not that there were reams and reams and reams of bad loans. It was an interest rate change, and frankly, a lack to hedge against that caused that failure. But when you look at the private world that we live in today, it's a really important, it's a very vital environment, but it also lacks liquidity. It lacks not a shortened J curve. We've gotten into a very elongated J curve. And for family offices, for institutional investors, that's a looming challenge. And what I want to talk about now is a little bit about the market structure. And this is looking at it not across 1 decade, but 2-decade cycles, right? I like to say we had a 80s to 2000 cycle that was all about traditional IPOs. This was the world of emerging growth capital, and the prominence of the NASDAQ and technology that has created this second cycle that has allowed us to live in this stay private forever. There's been a tremendous boom in private equity, and really a stay private movement that has created a couple mega cap IPOs, but has also left us wondering what's next. And I am a big proponent of global public listings and the global capital markets. And very few people realize it, but Asia Pacific now drives more IPO volume, both in number of companies and amount of capital, than the rest of the markets combined. And there's been rule changes that have shifted tech, right, and tech IPOs. It used to be that the only place to take a company public was on the NASDAQ or in the United States. And that very much drove the prominence of the US markets. London isn't sitting there as a market and a stock exchange saying, we don't need tech, right? Hong Kong isn't sitting there saying, we don't need tech, right? It's quite the opposite. You're seeing these markets shift. There's rule changes that have occurred at all of these exchanges to court tech. There was a really important set of changes at the Hong Kong exchange that Charles Lee drove that actually moved the rules such that firms like Alibaba, NetEase, Baidu, JD, and a whole bunch of others dual listed. And that dual listing was driving what was a period of called homecoming IPOs. And, but more important is the shift in global capital here. You're seeing companies be more global. You're seeing capitals flow more global. Marty mentioned the Australian Stock Exchange. You're seeing cross listings between the US and Australia. You're seeing cross listings into Hong Kong and Frankfurt and the Nordics and other places. I'm a big believer in the next 2 decades being a very global environment. And it's a bit counter-cyclical. I know we're today living in a world where there's a lot of anti-global thought, but I do think that there are some important shifts.
Good question.
Shoot.
Just on with Hong Kong, I'm aware of its importance for years, but now it's part of China for many years. Would you recommend that? I mean, just all the issues between the U.S. and China and the world.
I think Hong Kong as a market has lost a lot of its prominence for overseas listings. And look, there's a when you talk about Hong Kong, you're also talking about China.
Yeah.
I think what's a more interesting story is the incredible and rapid dominance that has occurred across Beijing, Shanghai, Hong Kong, multiple markets, and there's really an unbelievably vibrant capital market that has emerged. It used to be that if you wanted to raise large sums of capital, you came public in the United States, and we for decades have watched firms from China list here. and quite frankly, very successfully lift money out of our pockets and our markets into their economy. And it was quite effective. That homecoming has brought a lot of those companies home. I find it ironic that we here in the US don't think about, how do we leverage the globe, right? We've let everyone come here. We don't think about going abroad.
Right.
And if you think about, savings rates, right? The savings rates and the pension systems in some of these overseas markets are growing at astounding rates. And it's not as if those pension systems are sitting there not looking for growth capital, right? They want to be in this asset class and they want to be investing. And so there's going to be a prominence of some of these overseas markets that will develop. I'm going to quickly mention something, and Marty alluded to it earlier about venture capital here in the United States. And you're a lawyer, so Pete, I'm gonna mention something that most lawyers don't know, and that is that almost all term sheets and almost all venture capital, startup documents are modeled after the NCVA standard documents, National Venture Capital Association templates. Those NCVA docs prohibit the capital structure, that series A, B, C, and D that we layer in as venture capitalists, from collapsing the common unless that company goes public on the United States exchange. Now, there's some reasons for that are historical, but I think they're antiquated. And, I believe that we think very myopically about US only as the only place to list a company. I think it's the same thought process that 20 years ago drove venture capitalists to say, if you want my money, move your company to California, right? If I can't drive to your board meeting, I ain't funding your business. And we've seen venture capital shift. They'll actually fund a business in Nashville or Austin or New York. And it's shifted in part because you've had, VCs set up new offices and start to move around, and they actually now think nationally, right? I mean, once upon a time, you went public, on the East Coast or the West Coast, and you didn't go public nationally. Today, we have national markets. I think tomorrow we have global markets. Great. And I believe that we'll see venture capital evolve. And, my view is I'll be successful when those NCVA standard documents change, because I think it's crazy to, walk into a boardroom on a company that is growing at 100% per annum with 100 million in revenues and not be thinking about taking it public because it's not worth $40 billion yet. But that's the, hit-driven venture capital society that we live in today. The other thing is, a lot of people don't think about analyst coverage, index inclusion, and institutional support. And there are reasons why, if you're a $2 or $3 billion market cap company, you might want to go public in a different market and then think about coming, back to the US when you're larger. And so there's a lot of, thoughts that come into play, and it's largely why SPACs didn't work. I think SPACs were a bubble, a moment in time. It was a financial market innovation. In many respects, they were really, really poorly designed, right? I run a company, you run a SPAC. There's only two people that negotiate the dollar, price point at which we exchange. I have a fiduciary duty to get it as high as possible. You're going to lose all your money if you don't close a deal. So let's do it at 2 billion, 3 billion, 4 billion. And, suddenly, surprise, it was overvalued by 2x, 3x, 4x, right? And there were 300-400 of them, very rapidly hitting the market. That's why the SPAC bubble failed. What was, quite interesting is that it was trying to solve a very real problem, just with the wrong set of tools. And, I believe that venture-backed companies need to be thinking about going public sooner, faster, earlier. But not all companies should, right? Some of them, frankly, should stay private forever. And it can be because you have the right people on your speed dial, and you can raise billions of dollars as a private firm. It can be because your business model isn't ready for it, and it can be because you don't have an enduring moat that should be, public. And so, but for those that do have an enduring moat that can be public, we're depriving them of the ability to get there.
Well, I mean, so there maybe there's another way to look at it, which is that over the years, fewer and fewer companies have been going public, right? Up until the last 5 or 10 years, right? I mean, the number of listings on the stock exchange have gone down because of mergers and acquisitions, right?
Yeah, so mergers and acquisitions have gone up, which is great.
And IPOs have been down.
And IPOs have been down. And look, it's wonderful as an investor to see an M&A, right? Microsoft just bought your company. But between you and me, unless Microsoft overpaid by 4x, it's a travesty that happened, right? Imagine if Larry Ellison had sold his company to IBM. The value creation that didn't get created in that scenario is dramatic. And there are very, very few to no examples of founders that sold their companies and created dramatic value post that merger. It's where companies go to die. And it is value destruction, unless there's that incredible overpayment.
I got time for one more question.
I think I read in Bloomberg the other day that there's a hope that the IPO market's coming back a little bit. I think the restaurant chain Cava just went public, and so I think people are hoping, but it's not going back to 2 years ago.
So Marty, you said you like to uncover ideas that are countercyclical.
Absolutely, yeah.
Early. I look, the IPO markets will ebb and flow, they'll come and go, and we like to advise our, founders that we back, you need to be thinking globally, because they may come back in Asia or Europe before they come back here. It may make sense to, arbitrage multiple markets. You probably want investors from over there to be involved to create nexus that you may not have, right? So there's lots of ways to play that game. I do think that IPOs will come back. I think that pent up demand that sits with those, tech companies that have those multi-billion-dollar valuations are waiting to come back. And I think that, we will have a very vibrant market when we
replace Singapore, or
I don't have a favorite market per se. I have several that are favorites. I think that some have spent years, if not decades, courting the cross-border IPO. Whether it's London or Australia, to pick one in across each ocean. Question.
Well, it's not a question so much as a response to your question. And a lot of companies that could not raise
I
money
need you to move out of the camera.
here in America are now delisting, getting off of NASDAQ, going private, reincorporating in the Grand Caymans, and setting up in Beijing. And a lot of major companies are doing that because they can't find capital, like you said, and a lot of the startups. And so they're not looking for capital anymore. They're looking for government funding from China, from Singapore, but are finding investment opportunities from nonprofits. Think of Vertex, think of cystic fibrosis. And there are a great many biotech startups out of universities, research hospitals, waiting to happen. And no one knows about it.
No, you bring up a really good point. And I'll just quickly talk 2 seconds about, rules changes on exchanges, right? You couldn't take a, biotech company profitable on the Hong Kong exchange 5 years ago.
Yeah.
And they changed the rules to allow for, non-profitable biotech companies to go public. And they literally raised billions of dollars into, life sciences companies, literally in the 2 years in front of COVID. I mean, it was in hindsight brilliantly or very fortunately timed, but those rule changes are critical. London just changed their rules to allow for dual class, voting stock. It has sunset provisions and stuff that we don't have here in the US, and there's a big conversation around, do we let companies with no revenues go, public? And, that's vital to life sciences, right? But, these are tectonic shifts that are in motion. And, if there's one lesson I want to leave anyone here with today, it's that, you need to wake up and think globally. You need, your founders and CEOs of companies that you're backing not to be myopically focused on, 40 billion or bust for the NASDAQ, but actually, how do I think about, a global environment to play in, live in, work in? Marty,
Fantastic.
thank you.
Great job. Thanks so much, Keith.
Thanks, Josh.